Well, the Japanese yen is trading at its highest level in 15 years versus the dollar. That's even after Prime Minister Naoto Kan told reporters steep currency gains are undesirable. Meanwhile, the dollar is also falling against the euro. Shaun Osborne joining us now to break down the foreign exchange action for us. He's chief currency strategist at TD Securities in Toronto. He also tops the Bloomberg best list in both overall currency forecasting and dollar-yen forecasting specifically. That means his team is the most accurate of the strategists that we survey. So, Shaun, thank you very much for joining us. With this action that we're seeing in the yen, as I mentioned, we heard from the Prime Minister of Japan, who's talking about this level being undesirable. But the question many are asking is the administration there willing to do anything about it? What do you think?
Well, I think that's the key issue. You know, we've broken below 85 yen, and it looks for all the world like dollar yen's going to keep on falling at the moment. We think there's a number of factors behind this move, and these factors probably suggest that in reality the Bank of Japan should not intervene at the moment. That's not to say the government will choose to stay out of the market. I think they'll probably keep up this kind of fairly high profile verbal intervention for the next little while. But realistically, I think if they do choose to intervene, it's going to be a very expensive and long-fought battle for the Bank of Japan, and one that's ultimately not guaranteed to succeed.
So in the absence then of intervention, does the yen just keep going up?
Well, I think there's a good chance we trade down towards the 80 level, essentially retesting the lows that we had in the mid-1990s over the next little while. We're not that far away from it now, so it's not really such a brave call. And if we do break below that point, I think the chances of intervention perhaps increase a little bit more. But looking at the background here, we see an environment where interest rate differentials between the US and Japan are incredibly low and fully support really the level of the currency at the moment. And given, I think, the uncertain backdrop, at least for the US economy at the moment, it's highly unlikely that we're going to see those interest rate differentials move back in the dollar's favor anytime soon. Another point to bear in mind is that from a seasonal perspective, this is usually a pretty good period for the yen. In fact, over the course of the last 10 years or so, the period between August and October typically deliver fairly sharp losses in the dollar-yen exchange rate, and that ties in, I think, with the general risk aversion sentiment that we also see from a seasonal perspective a little more strongly in the August and September period. So I think, unfortunately for the Japanese at the moment, although the dollar-yen level itself is probably a bit of a worry, it's very hard to justify intervention at the moment, really, because in really effective terms, when we look at the value of the yen, it's not really obviously out of line with long-term trends or significantly overvalued at the moment. So I think there are a number of factors here that suggest that intervention may well come, but
Shaun,
ultimately it's going to be a very, very difficult
Shaun, we're out of time for right now. Shaun Osborne of TD Securities.